In this discussion, we will discuss the discussion question of compare a fixed and flexible budget. If we see a discussion question or an essay question like this, our goal typically is to expand on the essay question. We typically want to write more rather than less because we're more likely to touch on some points that could pick up more points, some spots that can pick up more points, some details that can pick up more points, and writing too much doesn't usually take away points. So if we have the time to do so, we're usually better off writing more than less. If it's a discussion question, then of course the contribution to the discussion in and of itself is usually where we pick up the points. So here we're going to be comparing the fixed and the flexible budget. Obviously, the first place we could start then is to define the fixed budget, to define a flexible budget, and then to go through the comparing and contrasting of the two, listing pros and cons of them as we do. A fixed budget is generally prepared before an operating period and presents sales and expenses for a single production amount. And so that's going to be a fixed type of budget, meaning we're going to have a set of numbers, a set amount of production level, and that will typically be what the fixed budget will be based on. We may prepare the fixed budget then in a normal type of income statement type of setup, rather than a contribution margin type of setup. In other words, we may set up the fixed budget as we would see on the income statement in more of a generally accepted accounting principles type of setup, where we have sales and then cost of goods sold, selling, and admin, as opposed to breaking them out by the behavior of the costs, that being between fixed and variable in a contribution margin type of setup, in which case we're going to have sales minus the variable cost contribution margin, and then the other cost of fixed cost to get us down to that net income type number. The flexible budget, on the other hand, is going to be able to flex in that we can show a budget for multiple production levels. So whether we have multiple different types of production levels, we can then create a budget based on those different levels of production. And that can be used before and after the actual period has been completed. In other words, we typically use a flexible budget type component before the period starts, really more for an analysis type process, a what if type process. And then we would often think of a fixed budget as being set up, the one that's going to be the primary map that we're going to go through the period with. And then at the end of the time period, once the time period is over, then we may want to use a flexible budget once again, because the flexible budget allows us to say, hey, what was the actual quantity that was produced in this time period? This is what actually happened. We predicted something to happen in the fixed budget in terms of production level, but that isn't as good with a comparison. We can't compare the numbers that budgeted versus actual and get as much analysis as we would like if they were based on different production levels, right? So we have to then use the flexible budget at the end of the process, flexing our budget in more of a contribution margin type style of an income statement to what the actual performance was in terms of units. And then we can compare kind of apples to apples, same thing to same thing, look at the differences in terms of the flexible budget and the fixed budget, and see what those differences are at the same production level in terms of units. We could take those numbers then, those differences, and further break them down if we so choose using variance analysis.